Good morning, everyone. Welcome to this edition of the faiVLive on the FinTech expectations gap. I will confess that I struggled to figure out exactly what to call this. This is a set of ideas that have been bubbling around in my head probably for a couple of years without really having my own mental handle on it, but came up in a recent webinar where Seth Gars from the Gates Foundation was presenting. I think it was an IPA webinar. I'm not even sure now who was running the webinar. Was that right, Tavneet? It struck me that I so often get involved in these conversations where the presumption of what's happening with fintech and digital financial services is very different about whether it's a huge positive for inclusion or a huge concern for consumer protection. And then it finally struck me that often those conversations, the difference in those perspectives were about whether someone was primarily operating in a developing country or primarily operating in a wealthier country. And that the conversations were probably a bit impoverished themselves for not recognizing that other side of the equation. And we start to see some of that bleed through occasionally, but I wanted to sort of explore the differences in those perspectives and what each side of these conversations can learn from each other. I often, I think, get a reputation for being the guy who says that, check out that dark cloud behind the silver lining. But that's not really how I am. And that's not what I'm hoping to do here is discourage people. It's to give people who think more in terms of consumer protection, a little bit more of the vision for the inclusion possibilities and the positive possibilities that technology can provide, but also for people coming from the camp of digital is going to sort of make a lot of things better, to understand how those things go off the rails often and why people in some countries are a little bit more concerned. So joining me today, I have an amazing group of experts from all over the world with who have been thinking about these issues a great deal. Lois Brew from MasterCard, Yinka David West from Lagos Business School, Tim Flocka from Commonwealth, who's got the best name, of course, on the webinar. Apologies, ladies. Barbara Magnoni from EA Consultants and Noahui Solutions, a relatively new startup in Mexico, providing sort of digital connectivity or digital inclusion in Mexico, and Tavneet Suri of MIT. And if you don't know Tavneet's work, you really can't have a conversation about digital financial services in poverty if you don't. So there's my inducement to any of you. Just Google Tavneet. You'll see a very wide range of things, both original research and sort of summary things that she's done that sort of really lay the groundwork for much of our conversation today. Quickly, some housekeeping. If you don't know how you got here, this is a live version of a irregular newsletter produced by FAI called The Five. And if you don't subscribe, please do. You'll see links to many of the things, some resources that we'll be sharing up on our site at financialaccess.org, and a requisite commercial for our major effort right now on original research, something called the Small Firm Diaries, where we'll be tracking more than 100 firms of 2 to 20 employees in 7 countries around the world, trying to better understand that segment of the market. Yinka is nodding because she's one of our partners in that work in Nigeria. With that, I'm going to get us started. I'm going to stop that, bring us back to our main screen. Tavneet, I gave you the plug of, the setting a lot of the groundwork. Tavneet, would you start us off? You've done some of the work on, what does the basic digital financial service, fintech, mobile money provide, and how does that affect the financial lives of poor individuals? And recently, VoxDev has produced the mobile money, VoxLit, is that?
Lit, yeah.
That summarizes now this explosion of research around mobile money. Would you just kick us off there, Tavneet, and what we've seen on how mobile money and digital financial services can start changing the financial lives of low-income households, even of the poorest.
Yeah, thanks, Tim. Thanks for the nice intro, the overly nice intro, Tim. I appreciate it. And it's nice to meet everybody on the panel. I think we've been doing work on mobile money for a while. The Vox Dev Lit came out about, I think, a couple months ago, Tim. And for those who don't know what lit are, they're going to be live literature reviews that will get updated every few months with more work. To be honest, Tim, we put that out and I got 20 emails with, oh, we have a new paper. We have a new paper. So V2 is coming soon, Tim, maybe in the next couple weeks, actually. So it's kind of been fun. It's a very active research area, which is great. Our original work basically showed that mobile money helped people deal with risk. So imagine your kid got sick and you didn't have money for medication, you would reach out to friends and family on the phone to get it. This is something you would do before too. This is not something that mobile money created, right? There have been hundreds of papers documenting the importance of our networks in emerging markets, and that's probably true for the poor in the US too, right? That we rely on friends and family far more than formal systems. And so what mobile money did is just reduce the transaction costs of doing that. Right. So, if my kid had a headache and I needed Tylenol, I wasn't going to go to my friend because they live, 100 kilometers away and that's a $5 bus ride. Are you going to take a $5 bus ride to get me Tylenol? No. But when something really big happens, maybe. But with mobile money, you can just kind of very cheaply, easily transfer money for every level of kind of bad thing that sort of happens. And so we basically saw that, when bad things happen, people were kind of more resilient to them. Get through them more easily, not have to, make hard decisions. One of the hard decisions we see in our data is when someone gets sick, you have to cut other parts of your budget to pay for medication. So no matter how rich or poor, it seems like health comes first. That is the first priority, which is a good thing in my books, right? But for people who didn't have mobile money, they had to cut other parts of their budget, often education, often food, often other things, which can be costly. If it's education, long-term costly, right, Tim? But with mobile money, people could reach out to their friends and family. We see them receive more money, receive money from different types of people, receive money from further away by people who are unaffected by the same bad events. So you kind of see this big improvement in resilience. And then we went back kind of 7 years later to look at, if I'm more resilient, I expect you to sort of take on more risk too, right? I expect now that I'm better protected, I can do higher risk, higher return things, which I couldn't do before because I was really worried if it doesn't work out, how do I feed my kids? Right? If I fail, I need to feed my kids. And so when you feel like you have this network that's more resilient, you can do that. And of course, that's what we see. We see people take on more risk. Women in particular take on more risk, which was surprising to us, Tim, not something I expected because of the microfinance studies don't find that much for women. So we weren't looking for something specific for women. But here we see very strongly the women start businesses, not the men. So they seem to be the ones taking on more risk. And then this is not even out yet, Tim. We did another round of data another 7 years later, which is last year. And those effects persist. So we see reductions in poverty. We see this shift in occupational choice, especially for women. And we're seeing that still happen. And that's like 14 years later.
Right.
Now, I think so that's been what we found in Kenya. And then people have now replicated that actually, which is kind of stunning to me because countries are really different. I don't expect it to replicate, but it replicates in Uganda. It's replicating in Mozambique. There's a new study out in Bangladesh a little, but they're also seeing the other side of the equation where you get the money from and it creates some stress on the other side. So it doesn't come without costs, right? But you're kind of seeing that. I think the other piece of DFS that's grown a lot since we started working on this is the kind of credit piece, as you know. And that to me is a little scarier. The mobile money piece, it's really reaching poor people. But ultimately, look, they're doing one transaction every couple months, Tim. And, our effects of the resilience are biggest for the poorest in our sample. The rich in our sample have, we're almost national in Kenya in our sample. The rich have other ways of being resilient, right?
Right.
The digital credit stuff starts to get trickier. It's not reaching the real poor because you're still kind of trying to screen who's good and bad risk. The interest rates are high. They're not always impossibly high, but they're high, and the loans are tiny. And it's mostly consumption and resilience credit again, which has a role. But, if you think of wanting to really transform things, I think we still have a ways to think about how to do that for the poor. I think I'm taking up too much time, so let me stop there, but happy to answer whatever questions anybody has or pitch in whatever you want me to.
That's great. And for those of you on the audience who are new to the faiVLive, this is a conversation between these eminent folks, but also a conversation with you. So feel free to use the Q&A to weigh in with some Q&A, some questions you'd like us specifically to answer, and we'll do our best to get to those. I will confess I have more than enough questions to ask these very informed people, but they may not be the best questions. So help me out with better questions. But turning from there to you, Tim, some of the things that Tavneet hinted at is there's a piece of fintech which is enabling people to be more connected to each other. But what goes over those connections, whether it's a person-to-person transfer or a formal credit offer, and pricing of things matters a lot. Tim, a couple of years ago, you and a group of colleagues put out this manifesto for the idea of fintech that's actually pro-poor in the United States. And I wonder, your thoughts as you hear Tavneet think about those contextual things of how your experience sort of working with financial services providers on the sort of the edge of technology and connecting people. When you hear Tavneet talk about these connections and some of the dangers in credit, how do you think about it, and what's been your experience in the United States?
Yeah, thanks, Tim, for that. And it's just a delight to join all of you. So you obviously gave us a heads up about the topics. I had a chance to kind of think, and I have a few thoughts on that. I want to say that, my experience is really US based. And so when it comes to making comparative statements, I have a question mark at the end more than anything, and hope I can learn from others on the call. But to your question, my organization is a proud not-for-profit. If you prefer, NGO, and we, as you said, banded together with 6 or 7 other not-for-profits who were united by a sense that technology actually is a powerful opportunity for we would say financial security, you can substitute financial inclusion, and a sense that exploiting that opportunity or seizing that opportunity was best done with a commitment to kind of build out products and services, not just at a direct service or community level, but at an infrastructure level. So all the members of this group were in some way offering products, tools that had really national reach. And a couple of things that we realized, and again, this is one with a question mark at the end, but somewhat ironically, I think, and to be clear, we didn't use this exact phrasing at the time, but we actually spend a good deal of time in the US trying to make the issues and the needs and the concerns of underserved people, or if you prefer, poor people, in sort of simple language, get those needs seen. And I wonder if that's a different challenge in a lot of developing markets. And it is a little ironic in some ways, I think, but a lot of what we wrote in our manifesto was saying there are a lot of people in this country who are much closer to the financial edge than perhaps the average American realizes, or than the public conversation suggests. Side note, I always feel like if you watch, just even television, like, who are these people? How do they support the lifestyles, right? Even our media has this myth about it, about who we are financially. And so we're constantly saying, these are needs that are unmet. And I think some of them probably are not dissimilar from other markets. But the ability to, to simply move basically payments, to simply move funds quickly, and to recognize that the counterparty of those payment transactions is perhaps more likely to be somebody outside of the financial system, the mainstream financial system, the lower income or the lower socioeconomic status. So that's a piece of it, is simply saying to this large, sophisticated, highly developed system in our country, there are people that are not being served. And then that gets to the second point, which is really trying to understand, and some of this feels cliche ridden at this point, but to really understand those needs in a way that requires probably getting out of your usual channels. And one of the things we feel strongly about at Commonwealth is, no surprise, the value of original consumer research, really trying to be clear about who it is that you're trying to have some positive impact for, and spending time understanding the world that they live in. And I guess the last thing is that there is still, I find, somewhat of a, I would call it a myth, that in the US context, income somehow predicts appetite for use of technology. And I just don't see that reflected. We happen to be doing some pretty in-depth work right now on AI, or if we click down really on chatbots and sort of automated forms of customer service and advice giving. And so this is just a fresh stat. We've seen a 200% spike among folks we've talked to under $60,000 in use of chatbots, since the arrival of COVID. This is not a population that's deer in the headlights, in a US context. So I think that's part of that I said at the outset, this kind of not really being seen phenomenon. And then sometimes there's still sort of these, oh, right, those people, and I'll just close with an anecdote. I can't recreate how, but I got to know a gentleman who runs a chain of check cashing in the Bronx in New York City, who's a delightful guy and incredibly thoughtful. And he observed to me, this is now several years ago, that his business had fundamentally changed. That there was a time not too long ago when he had teachers and cops and people who were very much in the workforce. And they just, that was the best option for them, was to come to his stores and convert their paychecks, and it probably was paychecks, into cash. He said, that's gone. Those people are all now basically using FinTech apps. And what he has is folks who are much less likely to be in the labor force, much more likely to be on some form of government assistance, frankly, much more complicated lives. And was even lamenting that it's tough because he doesn't necessarily have what a lot of his customers really need, and he senses that. But it's an anecdote, so you can take it that way. But I think that just really rung true to me, that is part of what has happened in the US, is that many of the people who once upon a time would have met their needs in a different channel now are firmly reliant on and very comfortable using technology. So I think I will leave it there.
Yeah.
Tim, can I just add, if I just
Please.
replaced US with Kenya, I would say the same thing. Much as you don't think that. I think it's just, there's more poor people and more poor people who are not seen in Kenya, but I would say both the same things. When cell phones and mobile money came in, everybody went, the poor are never going to use this. How are they going to use this? It has 100% penetration in the country, right? The poor are using it.
Mm-hmm.
So it's not as different as you might think.
That's nice to hear. Yeah.
I would just say it applies to half the population, not 10% of the population or something. Sorry.
Please, and everyone, feel free. Like, as I've told you multiple times, I don't run the conversation. I'm listening as much as being the hub here. But Tim, what you're closing there at the end reminds me of something that Greg Chen from CGAP said in another webinar that we had a while ago, that DFS is a moat and a bridge. It's it connects a lot of people to things that they weren't able to be connected to, but it can deepen the moats for some of those people. And that anecdote you're relating of the shift in who is using what technologies, potentially create some challenges in how products should be designed and who's using them, and making sure that we understand what the needs are of the people who are using them, because that's a big part of the story of microcredit. Is it was designed around this idea of what people were going to do with it, and that's not actually what they were doing with it. And it would be a shame to see a lot of that replicated in the fintech world. We, 20 years later, we figure out, oh, that's what the product was actually good for. But Barbara, I mean, turning to you, my conception of the work of EA consultants and of now Noawi is about connecting down to that consumer level. What are people really doing? And you are one of the few people who has your feet firmly planted in both the US and developing country contexts. What do you make of this sort of connection? How much in common is different perspectives on fintech between the US and developing countries because the contexts are so different, or is it something else and the contexts are much more similar?
Yeah, thanks, Tim. I wanted to kind of speak to Tavneet and Tim's point about, Kenya and the US aren't that different, because I think from the demand perspective or the consumer behavior perspective, you really don't see enormous differences. There are some contextual issues around security, trust of institutions. There are some things like that start to influence some behaviors, but where I see the real shift or the real difference is the business case, right? The business case in the US is very different from the business case in a developing market. And that's because if you're in a developing country and you have a product that has very small margins, so anything but maybe a loan, and even a loan has small margins in the fintech space, you need scale. You need a lot of scale. And in most of the countries that we're talking about, if you want scale, you need to go down market. You can't just stay at the top, right? You can't be with the urban middle class or urban upper middle class. You need to penetrate a much broader market. And so because of that, you see efforts in the US that are a little more pro-poor, as Tim was talking about, be nonprofit or, have kind of a more social bent, because you really have to push to get that to happen. Whereas in a developing market, you either serve that market or you don't really get anywhere, right? And which is what we're seeing. What I think is really important to think about, and that might just be my bias because of our company in Mexico, Nuevas Soluciones, is distribution. So I think the distribution piece hasn't really been explored enough or talked about enough because of situations like M-Pesa, where in Kenya it just kind of exploded by itself. It was super organic. And so we don't think about, how do we get these products out there? But the reality is that there are other products that could be very useful and helpful that just don't get distributed to the lower income segments. And I would say on both sides of the border, honestly. And in Mexico, what we do is we created this kind of omni-channel, omni-product platform that includes both like really high touch face-to-face contact and a much more low touch, social media, WhatsApp kind of based contact to distribute fintech products to low income communities. And something Tavneet said about women and risk kind of resonated with me there, because I've always said that like women are not more risk averse. They just have a different calculation to keep in mind. They have more to lose. And so if they have more to lose, they have to take less risk because the balance is different, right? And we're finding that working with women, in this kind of more face-to-face interaction where we're explaining products, showing them how they work, showing them what they can do for them, we get a lot more female take-up. So we have a product that we've been distributing that's a mobile wallet that's fantastic and people really like it. And two things are really interesting about it. First, it was designed more for like upper middle class, and we're getting good take up at the bottom of the pyramid, which we love because it's a useful, interesting product. It's a mobile wallet with some really simple bells and whistles that help communicate with your customers or clients or people you're sending money to. And the second reason is that it's the women piece of it is really interesting because they were only getting 10 to 20% penetration of women. We're getting something like 60% of the clients that we're able to take up are women. So we're seeing that like building trust and trying to kind of bring women in by explaining a product, showing them how it works, making sure that they have less to lose from it, helps bring those women in. And that's really important. What's the issue with distribution is it's expensive. So we go back to that business case again. So it's like, okay, well, we need slightly higher touch distribution. We need slightly more explanation, tangibility in the process, but that costs money. And then the numbers start to flip on us a little bit. So it's, I don't know, it's a challenge.
I mean, so many little threads to pull on across the board there. I will take two opportunities from what you said, Barbara. One of my great frustrations when I hear in so many of the conversations of people assuming that technology, DFS, is going to increase inclusion because it lowers costs.
Yeah.
And it doesn't necessarily lower costs, but it also lowers costs for everyone. So it doesn't change the relative profitability of serving poor customers versus wealthier customers. And then, for those portions of those populations that just want a little more handholding, and not saying it's exclusively poor people that need more handholding. Lots of really wealthy people don't want to go through technology channels. They want their personal concierge, but they're profitable enough to provide that. It's the poor customers who need the help that don't generate the profit margins to pay for the personal touch. And so we get sort of this recapitulation of many of the same things. I'm glad you picked up on, Tavneet's comments on risk, because I have the great privilege of being in a place where we sort of straddle between sociologists and economists, and there's a big gap in the perception of the word risk between economists and sociologists. Like economists are like, oh, great, they can take more risks. And sociologists are like, no, why are we pushing more risk onto these people? We've got to get them away from risk. And that's, I think, encapsulates some of these issues. But Yinka, I think you provide a really interesting perspective here from one of the most populous countries in Africa, with huge market opportunity, but in contrast to Kenya, where it seems like we blinked, and the Silicon Savannah, Nigeria, which from the outside has all of the elements and tools that should make it a world leader in DFS, is pretty far behind. Talk to us about like what you see from that context of why digital hasn't made as much progress, and what does that mean for inclusion and pro-poor development in Nigeria?
All right, thanks, Tim. And I just want to pick on Tavneet's comment that mobile money is not replicable. We've had the challenge in Nigeria for over 11 years now, and we've been trying to crack that code in general, and we still haven't done it yet. But I think that Nigeria presents very many conundrums in that, first of all, the regulatory environment has not been mobile operator led like we've seen in Kenya and places like that can actually sort of distribute services at a lower cost and to a wider range of people. So there's some license changes going on, but they're not taking the impact of the inclusion population yet. The other issue is the enabling environment. Nigeria is not exactly an easy terrain to work in, especially with some of the regulatory uncertainty and some of the things that we see. So sometimes that gives people jitters. It's a large country as well. So how do we think about distribution? And don't forget that because we have, on the demand side, we have financial and digital illiteracy, we have lower awareness of mobile money. So you really need the agents and the distribution networks as intermediary nodes to help serve the country. And what we're looking at is we need in excess of 1 million. Then when you think about the numbers, viability is an issue. So how do you generate economic activity to ensure that there's viability in that sense? And then how do we understand that, again, we're not a homogeneous country. There's the north and the south, and we have, in the northern areas, which are predominantly Muslim, we have Sharia laws and things relating to banking and usury that we haven't taken into account when we're talking about product market fit. So there's the product market fit, there's the regulatory side, there's the distribution, and then even on the demand side. So while we have high mobile penetration, right, it doesn't seem to have perversed all the way to the financial services ecosystem. Then I think another thing that has happened in Nigeria is that people don't want bank accounts. They want to solve problems, right? So the bank account is not an exciting proposition. So what's the bank account going to do for me? So what we're seeing now is mobile banking or mobile wallets being integrated into e-commerce, being integrated into logistics. So you're serving that the driver population, or you're serving the shoppers, et cetera, et cetera. The other thing, when you look at the fintech side, Nigeria is actually one of the core markets for fintech investments coming in from the north. But then again, you find out that the investments are really in payments and lending, and the use cases are different. So the use cases in payments are really about getting merchant acceptances on, and that's global acceptances now. So I can pay for Netflix in Naira. But then again, we're not expanding the market. We're still working with the same banked populations, and we're providing different propositions in those populations without really saying, how do we go down market? Mobile money awareness is still very low, and we just got the latest access to finance results, and we didn't really inch that much, so maybe about less than 1% growth in terms of the banked. So we still have a large underbanked population, but the growing part is really the informal. And I think that's where a lot of the Nigerian market, but the battle is with the informal. how do we address the market women who don't want to go to a formal location, who don't want to be identified, but they just want to continue their small savings on a daily basis? So how do we convert those informal into formal without necessarily just making it about the bank account? So there are many conversations that we're having. There are many issues to face in terms of, so we got the payment service bank license as well, in addition to the mobile money license, because in this case, the payment service bank license allows subsidiaries of telcos to participate. But we only have 3 licenses issued yet, and only 2 have actually started operations. So it's early days, but we hope that sooner rather than later, we'll begin to see some traction in Africa's most populous nation, not one of the most populous. Thank you.
Thank you, Yinka. Lois, I want to pick up on that thread that Yinka was sort of ending on, is, how we extend services isn't just about bank accounts. And the contrast that she was setting up between mobile-led versus bank-led versus payments-led versus credit-led, there are a variety of ways. And specifically because, Lois, you've built a couple of reach the poorest social enterprises before your time at MasterCard. What do you see that's encouraging about lessons learned that building actually pro-poor systems rather than having it just be an accident along the way? Lois, you froze up there for a second.
All right, should I start again?
Yes, there you are.
Okay. I wanted to pick up on both Yinka's and Tim's comments there on getting people seen and making, so when you're serving market segments, and the market segments I've tended to focus on are even, I would say, a customer segment even below mobile money, where they are entrenched in cash. Digital is fairly new to them. And how do you get people who are living on $2 a day? So my experience is on the international side, kind of as a complementary viewpoint to Tim's.
It switched back to mute, Lois.
I hope I'm back.
You are.
Okay, I lost everybody there for a minute. So how do you get people make it useful for people who are brand new to digital? Digital is a little bit voodoo if you're living on $2 a day. You have to really into their daily life. So how do you do that? So I did some work in the field for our the MasterCard Lab for Financial Inclusion in Nairobi, and what I was out there to figure out was, how do we make digital financial services embraced by this market segment? And some of the things that I found out there have been well discussed before. Some of them are I think them into 4 areas. One was human behavior, second was infrastructure, third was commerce, fourth was product. On the human, you know what? Let me. I'll turn off my video so maybe you'll be able to hear me better. It's a good suggestion. Is that better?
Yeah, we hear you. Hear you clearly now, more clearly.
Okay, wonderful, thank you. Sorry about that. I'll have to talk to my internet provider about that. That's happened to me on my last few calls. So on the human behavior side, when you're introducing to a rural, especially rural community, trust. So you have to, what I call them product ambassadors. People that are influencers in the community, people, from different socioeconomic strata that you can educate about this new service, and then have them tell others because you'd rather hear from your neighbor or a friend from somebody who's come to sell something. So getting that kind of trust network into the community is really key to building human behavioral changes that you need to embrace digital. You also have to take into account gender. Women on board, they may not have control over the mobile phone in their home. They may not have control over the funds or the bank account. They usually try to manage the funds in the best interest of the family, but you have to take into account gender strategies. On the infrastructure side, you have to take into account the need for offline capabilities. Mobile money is great if you have connectivity. Most people are on sort of the edge of the footprint, or the connectivity is unreliable. So any solution has to consider, how do you reach people who are in rural areas who may not have reliable access to connectivity, and also to have a presence in those rural markets, because people trust. One of the successes for mobile money was having the density of the agents in those rural markets, so people okay, if I put my money into this thing, I know I'll be able to get it back out, and I can trust that. So that's on the infrastructure side. On the commercial side, and I'll wrap up my remarks in another minute, make sure that there's value for everybody in the value chain. Loyalty program regard, especially user input. As a product developer myself, there's nothing like being in the field and seeing people work with the tool that you're proposing, lights up their eyes, seeing what confuses them. So getting the user input into the product you're designing. And then specifically for digital financial services, co-locating. If people are receiving money, P2P disbursement, make sure they have places to spend it digitally. So they're not just cashing out and turning it all into cash. So receive and spend.
Lost you right there at the end again, Lois. But I want to take off from that, the digital ecosystem kind of thing that you were referencing there at the end, and Tim, sort of bringing the conversation back around to you. This is one of the tensions that digital makes transactions potentially far easier and less costly. But sometimes people need help making transactions harder and more costly. When I think about why the perspectives in the United States tend to err more on the consumer protection side, it's because we have a really well-developed infrastructure on helping extract people from their money. It's not, the problem is like it's hard to transact. The problem is it's hard not to transact. And some of the concerns you start bleeding through, in a place like Kenya, where it has such high penetration, is this wave of digital lenders who are texting you every couple of minutes to remind you that you can borrow a little bit more money, and don't you want that thing? And so that they're more like Target, Walmart, and Amazon in terms of finding more ways to get you to transact than it is enabling transactions that were harder, that allow you to support people. One of Commonwealth's big focuses is, how do we help people build emergency savings? When you hear these things, like, how do you think about how do we find a balance between making it easy for the poorest to transact in ways that are beneficial to them, without making it even harder for them to build the kind of cushions necessary to survive the kind of volatility that they encounter?
Yeah, well, I might be unpopular on this one, but I chafe with that notion of we need to find ways to introduce friction. And I know that this is a cheap shot, but it just sounds too much like it's just a little patronizing. So let me offer a slightly different frame. I really think I can say this authentically. In 20 years, I have really yet to meet a person who didn't value saving and having some savings reserve. Like that's not rocket science. That's pretty intuitive. And a lot of times, at least in our work, you do fall into that place of like, those people, they just need to know. And it's like, no, that's not really true. And so I like to think of our work as helping people get where they already want to go. I don't want to be in the business of trying to convert people to something. First of all, I don't think it works. And secondly, I don't think it's necessary. So to go back to your question, and maybe this is all semantics, but maybe it's about rebalancing, because I think you're right. There are a lot more forces, there are a lot more incentives, both for consumption and for borrowing, right? So it's not so much that we need to protect people from that, it's that we need to make sure they also have good choices for building up even modest amounts of savings, which again, somewhat hard to believe, but in our super well-developed economy in the States, like there aren't actually really good choices for people to build up small amounts and draw them down because it's a tough business case. And, so we've been working on that in various ways, I mean, the themes have already come up. You got to find different distribution channels. You got to find folks who have different incentives, right? And an obvious example is the workplace. Like, employers don't offer emergency savings tools because they're making a profit on the P&L of that particular standalone feature, right? They do it because they have a stake in having workers who are not spending 30% of their mental energy asking whether or not their check is going to bounce. You can make that case. And at scale, like we've done a lot of work to try and pull the retirement system in the US and have them just marginally expand their scope to also support workers building short-term savings, which is not an incredible reach, right? But that's a different, they have the infrastructure. It's an incremental add in many ways to extend that to short-term savings. So the economics are different. And again, the incentives are different for those guys. They want to have a full set of features for their employer customers. There's at least a solid intuition, if not a totally empirical case, that people who are short-term have greater stability are more open to long-term savings. So, and then the last one, and this is like, I don't know, I'm right at the edge of saying this, but I do think that there's a role for government here, well, a number of roles, but the one I'm thinking about is just trying to set the message about what's, it's sort of normative, right? I mean, we have a history in the US of saving in government debt being a patriotic thing to do, right? We used to have movie stars doing public service announcements saying, buy US savings bonds, it's good for you, it's good for the country. That may not be the highest and best use or the number one role for government, but I do think there is something there around shaping public norms that we can't realistically look to the private market to do, and is part of that, again, in my language, sort of rebalancing the forces of driving debt, driving consumption. But this is a place where I would love to hear from people. I see comments come through. It may be that I just have a lot of blind spots, and there really are terrible stories, especially in developing countries that I wouldn't be aware of people who are kind of lambs to the slaughter and receive those text messages you described to them, and like, oh look, yeah, I'll take that, and I'll take that, and I'll take that. So.
Hey, let me jump in and just
Yes.
say, let me be clear. I think the digital credit piece, the study we have actually improves resilience a little. So, I just want to be clear. It's just not reaching under $2, right? The average consumption in our data is about $3.50, $4. So even if it's doing something, it's not reaching the very poor. The worry I have is that when it does reach the very poor, we have less understanding of exactly what the product is and conditions around it, right? So for example, Kenya set up a credit bureau recently, right? So Tim, the other Tim, Tim F. One of the stories is someone getting reported to the credit bureau for not paying off 0.01 US cents on a loan. And it's because the digital system it rounded somewhere and put this person in default without realizing the amount it was defaulting over, and then report, So I think some of this is also just teething issues with setting up digital things for the first time and not realizing, oh yeah, we should just check that wasn't some rounding error and someone got reported. And the only way they knew was they got rejected for a loan, had to pay $20 to get a credit report, and then found this out, right? So my bigger worry is not that this doesn't help people. My bigger worry is just the dynamic implications might not be so clear to people who've never borrowed money before. And, the credit bureau kind of knocking you out of the entire formal credit market based on you not repaying $1 of a loan seems like a bit of an excessive punishment in my eyes. And so when we get to digital things, I think yes, you want to penalize someone for default, you want to do all these things, but I think we have to think about maybe the standard credit bureau is not the right way to think about these products for very poor people, right? Because they might, you're going to kick them out of an entire system forever based on like some tiny amount. So that's all I'm saying. We actually find improved resilience, right, out of our digital credit product. The paper's just out now. But I think there's a bunch of slightly more complex issues here when you go to developing countries because of the tie into regulation and the tie into consumers not realizing all of those pieces clearly because everything's on a non-smartphone, right? It's on a tiny little flip phone or whatever, and not having proper terms and conditions. And, you know, the way I describe it sometimes is, you know, iTunes, I accept all the terms and conditions. I have never read a single word of those terms and conditions. And the reason is, I assume that if there's something bad there, someone in America will have read it and will have gone to court or made a fuss about it, so I'm protected. This is not true in developing countries. I think that's the difference, actually, one of the most salient differences to me. No one can assume that if there's something bad in the T&Cs, it'll get caught by someone and get into the legal system to be stopped, right?
Yeah.
And so, you know, having T's and C's that are more visible, I think, is important. I'll stop there.
Yeah. Although, I mean, I think that's a great point, Tavneet. And Barbara, I know that you were going to say something there, so I'm going to come to you just a second. You know, I think, Tavneet, you hit on sort of one of these concerns about the way different systems and whether people want to serve poor customers rather than automatically assuming that poor customers will be served. But also, you know, I see this assumption that does apply to those of us who with pretty steady and relatively high incomes, that nothing really bad is going to happen to us. And then, you know, I think about the Uber drivers in California who accepted all the terms and conditions. And, you know, there's this relatively new innovation that they figured out that they had been shut out of the court system by accepting our mandatory arbitration. Relatively recently figured out that if they all file arbitration claims simultaneously, that actually wrecks Uber. And now Uber is trying to push them back into the court system, right? And so there is this process, but that's a pretty complicated process. And I think there are still lots of people in developed countries who are shut out of the protections because they don't have the confidence to challenge when they're being treated badly. When a bank treats me badly, I don't just get angry. I assume somebody's going to take me seriously. There are a lot of people in the country when the bank treats them badly, rightly assume that no one cares. Barbara, I did see you come off mute, so I know you wanted to weigh in on that too.
Yeah, I mean, I kind of wanted to touch on two things. And one is sort of big and macro and geopolitical. It's been irking me a little bit with the FinTech kind of inclusion discussion, I think in both sides of the, you know, north-south hemispheres, which is transparency and tax collection. I think that there's this big focus, particularly now with all the fiscal deficits that so many governments are running, to collect more taxes, and the small commerce that has not been paying taxes becomes a target. And you're really kind of working against helping them out with these products. If anything, you're thinking about, like, you know, yeah, you can make more money if you take credit cards, but you're also going to show the government all of your credit card transactions and therefore be taxed. And so the incentives kind of get skewed. And I think this is a place where government needs to really think about what they're doing before going there. And I don't think it's easy, because I think a lot of this is US policy driven and pushing it out to other countries. So plus all the obviously commercial interests. So it's tricky. And I think that it is a risk right now in this space and in coming up with cool products. On the credit side, Tavneet, I completely hear you, and I've worked on projects to try to make those terms and conditions more transparent and more, you know, easy to understand in the sequencing and the wording, et cetera. And so I totally get where you're coming from. At the same time, you know, I think about microfinance, and before the financial crisis in 2009-ish, in many of the countries that we worked, there was this kind of underlying assumption that, like, you don't really need to report to the credit bureau if the loans are small. If the loans are under $200 or whatever, like, there's no need, it's costly, it's extra expense, they're small loans, whatever. And I'm kind of extrapolating that to the discussion here and thinking that this might just be a maturity factor and not like a principle. Because then you got the financial crisis, and in Nicaragua, where I worked a lot, the financial crisis hit the microfinance sector quite a bit, and you saw non-performing loans jump really high, et cetera. And coming out of that, all the MFIs that survived started reporting to the credit bureau even tiny little $50, $100 loans, because they realized that it was in the interest of themselves, their own institutional sustainability of the market, and of creating a payments culture. And that's my fear, is that there isn't any effort in these like mobile money loans to create, and I know the word culture gets overused, but this kind of discipline of saying you borrow and you pay it back. And that's kind of how it works. And you pay it back on time, differently from if you borrowed from your mom or your sister, where you could pay it back a little late or in parts. But like when you go into a financial institution, there are some rules that you have to follow. And if you don't follow those rules, there are consequences. Because by not sort of educating your population to understand that, you are creating huge systemic risk. And you're not allowing people to then graduate to more formal, larger loans. And so they're just rolling consumer loans back and forth, which is helpful, I agree, for dealing with short-term emergencies, but it's really not getting them to what I hope that we'll do with loans coming out of the pandemic in particular, which is economic recovery. And that's what we really need. So I'll stop blabbing there.
Thanks, Barbara. And apologies on sort of losing Lois along the way. Clearly, some of our assumptions about where quality technology connections, Lois is in Manhattan, but having some connectivity issues there. Which I think is a great metaphor for our whole conversation and the commonalities between countries and what's going to happen. But Yinka, go ahead.
I want to pick up on Barbara's comment regarding tax and this whole taxation issue. And that's a big problem for distribution in Nigeria, because we have multiple layers of taxation. And one of the biggest challenges is where you have a small agent location that's being taxed by the local government, the state government. And to be honest with you, these levies are not documented. So every day you have a different collecting agency citing one law or the other that you're so basically not even aware of. So little things like that have even, even after the protests with the youth in October last year, one of the biggest issues was any young person carrying a laptop was almost now labeled a scammer, an online scammer and things like that. So our education has to go beyond just even the consumers, even the law enforcement agencies, and just to ensure that we all understand what's going on and we're not sort of robbing Peter to pay Paul. Because then we are sort of forcing out distribution agencies, and then all of a sudden the law enforcement agencies are closing them down. So we're making 10 steps forward, 100 steps backwards every day. And it costs a lot of money to start these things, build the trust that it's taking a lot more time to build that trust. And then all of a sudden we're eroding that, all that value, all that investment capital is just going away. So there's a lot of education that needs to go around the policy of financial inclusion and DFS and FinTech in general. Thank you.
Thanks, Yinka. So yes, my bias tends to be on what is the intention of the provider, but there's a whole field of economics and public choice, and what are the intentions of the regulators, and what are their incentives along the way. And Tim, I know we've seen some of this in the United States. Why the CFPB was created in the first place was because there weren't really that many regulators whose job it was to think about consumer protection as opposed to the stability of the financial system. And, you do what your job is. And, I think that sort of can shape a whole lot of what gets offered and delivered. Lois, do we have you back?
Yes, finally. Sorry about that. My corporate and personal network went out.
Well, we're sorry to have missed you. We said really nice things about you while you were gone.
Thank you.
Lois, if you were thinking, I know you've missed some of this conversation, but MasterCard touches virtually every part of the financial and regulatory system by virtue of where it sits. As you think about sort of the principles for MasterCard's work and sort of the humanitarian development, this idea of we're only going to serve poor people if we actually want to serve people. How do you think about principles for the relationships that MasterCard has to advance those things to ensure that consumer protection is part of the conversation, that serving poor customers is part of the intention?
So there's a few parts to that question. There's the serving the poor people as part of the intention. Let me take the first part of your question first, which is how do you ensure that you're sort of protecting the people? And for us, it all starts with data protection and data privacy. We consider that the individual owns their data. And I think you have to start there to ensure that people understand the permissions that they're giving. I dropped off when I heard Yinka referring to, or I'm sorry, it was Tavneet's referring to, the terms and conditions. People, what we try to do is to explain how data is going to be used when people are signing up, verbally explaining to them, do you understand, to make sure that that's fully embraced. So I think data, and then how we treat their data and what kind of personally identifiable information we keep and store, or most importantly, do not store, is key to that. So I think consumer protection really begins with data privacy and data ownership. I would say on your second question on how do we decide who we're going to engage with, our philosophy generally is to do well and to do good. MasterCard, as you may know, has committed to connecting 1 billion people who are previously underserved and disconnected from formal financial services to the formal financial sector by 2030, and 50 million micro merchants. We think that is good for society. We think that's good for us in the long term. We'll do that on a break-even basis as a social enterprise. We don't have to make money doing it. We just want to cover our costs. And not everybody has that luxury, but in the long term, we think it's good for us as a company. We think it's good for society to get these individuals connected to the formal economy. It makes for an eventually more stable middle class if you get the lower class people connected to the formal economy, and that in the end is good for society and good for business.
Lois, I know your time was tight in the first place. I appreciate your efforts to stay with us here. So
my apologies for all the technical snafus today.
No worries. It was a great case in point about the commonalities between developed and developing countries. Is you can't always rely on connectivity, even in Manhattan.
Right.
But do feel free to sort of run off. I know that you've got something right backed up to this.
Yes.
Thank you. For the others, this conversation could obviously go on and on. I would wish it too, but we are going to try and sort of wrap it up here. And coming back to the original question of what are some key features that we need to be thinking about if FinTech is going to be pro-poor, getting away from the presumption that FinTech is going to serve poor people just because. And also getting away from the presumption that digital is a tool of exploitation of the poor, that all actors are bad actors, and we need to start from a presumption of bad faith, which pervades in some situations. I know this is going to be a difficult question, so I'm going to put all of you on the spot here with this, but. I mean, if you were thinking through what are a couple, 1, 2, 3 things that you wish more DFS providers or the people sort of DFS near actually thought about when they sort of come to this space and think about what they're doing. And that can be either, I wish they understood poor, sort of as I wish they understood poor people better, or I wish they spent more time on the technology side, very wide ranging. What do you think we need to be thinking about more to ensure that DFS in both developing countries and developed countries is a pro-poor tool? Barbara, I'm going to start with you because I know you'll still talk to me even though I put you on the spot first.
course I will. So I'm going to just kind of stick with my distribution comment from before because it's what I think about a lot. And I think there are a lot of different things that could answer your question. But on the distribution side, I wish in developing countries in particular, but I think here too, that fintechs who go into this market would not go right to digital marketing as their distribution strategy, because it excludes poor people, it excludes women, it excludes people who don't trust, and it only captures a small part of the market. By the time they figure that out, it takes them a long time, and it is wasted time, honestly.
Tavneet?
Yeah, I'll do one which I haven't talked about yet. So it's a good thing to do. I actually think product diversity, Tim. If you look at all the lenders, they're all doing a 30-day loan. I'm sorry, a 30-day loan does nothing for me. I have to pay back in 30 days. What's going to change in my life that I can pay back a loan at 7% per month in 30 days? And every single one does a 30-day loan. Sure, 1% of people, 2% of people, that's a useful product. We see no product diversity. This is my big fight with mobile money, right? It started in Kenya in 2007. It was universal in our 2014 data. We've had almost 7-8 years of universality of a payment system, yet there are no products on it. I built you these beautiful rails, or someone built you these beautiful rails, build the damn trains, right? So we have no product diversity. The fintech lending is the only product that's really scaled out, and it's the same thing for everyone. If I walk into a bank in the US, there's 100 products. So I think we have to start thinking about product diversity because different people need different things. And if they need different things, I kind of need to provide a suite of things to capture the market. And everybody wants to do one thing and then copy it as if this is going to be the be all and end all. So I really think we need people to think more carefully about product diversity and tying that to needs, which is what Tim said earlier, right? You know, just to link it back to that, I don't think we do enough of that, even in developing countries at all. And that's the piece that I find so somewhat depressing, because it's been 10 years. Surely we should have done something more, but I'll stop there.
I mean, Tim, that's a great intro to you, because a lot of what Commonwealth does is try to figure out what products actually can meet some needs, and getting people to sort of do things like prize-linked savings and you know, the emergency savings work that you're doing now is like actually designing products that work for the consumers. So to you, your thoughts.
I mean, I'm going to go conceptual. I guess there are two things on my mind that interrelate. One, I wish, I think that was your prompt, right? I wish that as individual providers and as a field, we started more often with the outcome. What is the outcome that we're hoping to achieve for people, and work backwards? And that sort of leads to the second thing, which is I really am optimistic about business models where the incentives are aligned. There are not a ton of them, but you know, all the issues around trust. I mean, I think if we saw more of those where it was just really clear that I only win if you win, like a lot of these things will start to get easier, and people are savvy. They sense, even if they can't name it, like, nah, you know, you're going to get better off by me being worse off. Who wants a part of that? So those are two North Stars for me.
Yinka, to you, I think, you know, Tavneet's comments about everybody doing cookie cutter things, like this is a really, you know, the Nigeria context is the idea, well, they did it in Kenya, of course it's going to work in Nigeria, is a real problem. So your thoughts on, you know, what you wish people thought about more?
Human behavioral differences. I think that we assume that everyone wants a mobile product, wants a banking product, rather than asking, what are your aspirations? What are your goals? And how do we build all those things into our products and build the diversity? So it's really not about looking for the big wins, but it's really the small wins that help you build the big wins. And you know, one thing I like to remind people about is that Nigeria is diverse. So we have English as our lingua franca, but it's not our language in that first sense. So how do we even bring products to people when they're in English? So we're already creating more barriers. So how do we close all these gaps and build products that are native and intuitive to them? And I tell people that it's not financial literacy or anything like that. It's user design, because everybody can design a product that suits someone. Even an 18-month-old can use a tablet. So it's not about literacy and things like that, but how do we think around how people see things? How do we think around how people work with things and how they use money and create better products to help them manage their money and use their money? Thank you.
Thank you, Yinka. And for those of you listening who know me, I did not pay Yinka to say it's not about financial literacy. I would have if I had thought of it, but I appreciate those comments very much. We're a bit past the hour, so I want to wrap us up with a few sort of closing thoughts. Logistically, we will follow this up with some posts on financialaccess.org with some of the questions and comments that we didn't get to, and asking the panelists to respond to those in writing. So if we didn't get to your questions, what I've tried to build in as we went along the way, there will be more opportunity for that. All of these folks are incredible experts in their own right. And if you don't follow them via either their sites or Twitter, you should do so, because you'll get much smarter. Certainly, if you're not reading Vox Dev regularly, then you're doing it wrong, because it's one of the best sites for people interested in these places, but non-economists, to actually understand the leading edge of economics research. So let me commend that to you highly. Finally, let me wrap up by saying the only reason this exists, these conversations exist, is because of support from the MasterCard Impact Fund and the MasterCard Center for Inclusive Growth. This is part of something called the Financial Security Insight Community that we are sponsored here to be able to deliver content like this. So many thanks to them for providing the funds for us to be able to do things like this and make it free to everyone, so we don't have even a small payments barrier to people having conversations about DFS. On that note, I want to thank finally this fantastic panel. I'm often humbled by these people that I can get to show up to talk to me and put up with me and my sometimes impertinent questions, and sometimes my very last minute preparation and planning. So very much thank you to Lois and Tim who had to drop off, but also to Yinka, Barbara, and Tavneet who have stuck with us. Please do keep following us. If you don't subscribe to the Five, you'll see a lot more of this conversation in the Five, which you can subscribe to at financialaccess.org. And I will wrap up there. Thank you everyone for attending, and we'll look forward to continuing these conversations about how we make sure that finance reaches the poorest in ways that are actually good for the poorest, and appreciate the work of everyone here in getting there. Thank you everyone, and have a great day.
Thanks for organizing, Tim, and bringing us together. It's nice to meet everyone.
Thanks, nice meeting you all. Bye.
Thank you. Take care. Bye, Tim.
Bye.
Bye, everyone.